So I wish I did this last week because I know a lot of people want to talk about what's going on in Russia and the Ukraine, but I thought it would be important to take a look back at historical parallels to inflation and what the markets did during those times. So let's get into it and we'll go from there. And Jonathan Dane actually got this as right as anybody last year when we were raising the issue of what inflation would do. And I was in the camp that it would be more transitory. I think it's been proven not to be. However, I think also the deflationary tendencies for the global economy that were in place before will reemerge. And those are primarily the demographic issue. We have a big problem with that around the world. The debt issue, I think, is another big one. And technology continues to be highly deflationary. So the one thing that took a big hit was globalization, and that is related to the supply chains. But going back to World War II, there have been 6 episodes of inflation defined by over 5% CPI increases. They're listed here. I want to touch on 2 of the big ones, the oil shocks of the 70s and also the post-World War II period, because I think those 2 are the most relevant for the discussion today. A lot of people are using the 70s as the example of what happened, but let's take a look at those 2 and see what it relates to for today. So this is a chart going back to from 65 to 85, and you can see the inflation tendencies that were coming. To give you a sense of what drove this, particularly in the early period, the economy was really hot in the late 70s and it was in the late 60s. It was running at about 5% growth rates a year. So you see that was the big push for the initial inflationary surge. The second was the oil embargo. The Shah of Iran, they had the revolution there. He was took down. And then you had Iran and Iraq at war. And that led to the oil price spike. And then came Paul Volcker in 80 and 82, it drove it down. So that's what happened. But what's interesting is, look at the market. The market bottomed in 74 and continued to move up from that time forward. So a lot of the message that I'm going to give today is you have to look forward. And I've been saying that quite a bit lately, but the market discounts things and it is a discounting mechanism, and you have to keep that in mind. If you go to the post-World War II period, which we think is a little bit more applicable today, to today's time, you can see the inflation coming up from after World War II. If you look back, 39, we had the New Deal that started to push things up. The post-World War II, the post-Depression period, and then you started to see, as we entered into the war, inflation was on the rise, but it came back down sharply around the Battle of Midway, way before the war ended. And then it spiked up sharply after. And it's this second spike in 45 to 47 that is the one that we think has the most comparison to today. And what was going on then? You had rationing going on during the war. So you had limited ability and access to consumer goods. The government was rationing food, sugar, coffee, meat, and cheese, as well as automobiles, tires, gasoline, and shoes. Personal savings rose significantly and were spent soon after the war ended. Sounds familiar. Give you a sense of the numbers, though, and what happened after. Between 1945 and 1949, for a population of about 140 million people, Americans purchased 20 million refrigerators, 21.4 million cars, and 5.5 million stoves. So a lot of the shortages that they were finding was goods, and there were also housing shortages there too. But what's interesting is when you look at what happened in the market bottomed in 42 after the Battle of Midway, well before the war ended, and continued to move up all the way through the inflationary period of the Korean War as well, which was a very short one. And what was interesting about the shortages in the Korean War was when we were going back into war, people front-loaded their buying of goods so that they wouldn't get caught in the shortages that they experienced in World War II. So let's look at the elements of what went on here. And this is actually interesting as a corollary to today. The dark blue is from a period of February of 1946 to August of 48. And you can see the spike up in food, in apparel, in rents, fuel, electricity, and refrigeration, as well as home furnishing and everything else. But what happened and how quickly it came down, this is about a 18-month period that you're looking at, and the drops happened very, very quickly in food, apparel, and other areas. So I think we're going to see some similar things here, but not necessarily the same. We're in a different economy, so there will be different elements that we experience. So we've had these big moves in the market, and we're looking at another tenuous period where we've had a lot of volatility, and there's notes out from Jeremy Grantham and others that this is going to be the fourth big one and all that. I'm not sure. I respect him immensely. He's been brilliant about it. I think what's happened over the last, since the financial crisis, is the monetary policies of central banks have distorted the markets to a degree that the traditional way of looking at them has been put under pressure, and that's why a lot of value investors have been caught off guard in this process. So as we sit here today, we think that the markets are going to be challenged by the geopolitical situation as well as the political situation around the world. And we also have this transition from monetary policy and the uncertainty around fiscal policy. One of the key things that I'm looking at today is the divergence between what China's doing, where they're lowering rates to stimulate their economy and really work against their slowing economy. Europe is maintaining. In the emerging economies, there have been at least 55 rate increases over the last 12 months. I think there'll be more to come. And then you also have the South American nations really struggling with their health issues. So that's actually creating some other problems as well. So as we look at what's going on around the world, you will see big divergences, and that's going to play out in how individual economies will be able to sustain in this period. So I'm going to stop there. I know there's a lot of other things that people want to talk about, Mark. So let's stop there and take questions or comments.
Stephen, I missed it. All the rate hikes that you just mentioned, where were those?
Well, throughout the periods, and that's an interesting point, Bill. I saw something yesterday on rate hikes and what happens after the first series, and JP Morgan did a report. They were saying that the S&P average return in 12 rate rising cycles since the 1980s, since the 1950s, the S&P average is 9% in those rate hike periods. So we often get it wrong that the rate hikes are usually a reflection of a strong economy, so the markets will continue to move up. Even though the inflation's moving up, they're trying to slow the economy down, but it all works in a lag effect. So that's why people get it wrong. When the rates are moving up, initially they think that that's the end, but it's actually the economy's still moving quite strongly, and they need to the markets reflect that more than the sentiment does. I'll try and send around to the group a article on that. Barron's had an interesting piece on that just this week. Good questions. I was hoping for some disagreement. Alternative views.
Stephen, I got a question. On your chart that you compared, I guess, during World War II versus, I'm guessing, current with the pandemic there, there was a lot of, yeah, I think that chart right there. Yeah. So during that time, a lot of the domestic mobilization, though, has been spurring out to work. So you're getting a lot more people into the market there compared to a move to at work employment and not so much additional business. So do we have any kind of insight on the comparison to see how that kind of played out with employment?
Well, yeah, their employment, obviously when you had all the guys coming back from war and you shifted from a wartime economy into a massive industrialization run. And think about it, when I live on Long Island, the Levittown homes, we had huge housing shortages after the war. So that was a big issue why all the consumer goods were being bought. And then once the goods were bought, they shifted back. I think you had an employment scenario that was a similar, it was different in the sense that this is because of war as opposed to a pandemic, but you did have a lot of people move out of the workforce for a variety of reasons. And then you had to rebuild the workforce up as well as you're rebuilding the economy. So I think there's similarities there. We're in a bit of an unusual spot right now because the lockdowns are a little bit different. So you can't actually always draw a straight line comparison to any of these. I think the current status is more a reflection of many of these elements, but I think if you're doing it on a high level, it would be World War II would be the most appropriate comparison because of the supply chain disruptions which the war created, as well as the shift of the need to go from goods to services, rebuild the goods up, and then you had that intense demand in a short period, and then it shifted to services after. And I think that's what is going to drive this change, and it will create a different level of, I think, employment. And the employment economy is shifting here in the US as well with the gig economy and now with robotics coming in to fill some of the roles. I think the other element that we were seeing during that period was a lot of immigration after the World War II as well. And we don't have immigration right now. And I think that's actually going to hurt a lot of economies, particularly ones like the US that rely on immigrants to come in, work their way up through the jobs that as people advance up in our country that need to be filled on the lower end. And I think that's one of the shifts that is a little different now than it was then with the gig economy and the lack of immigration coming as strong as it was.
Interesting.
Other comments, perspectives? Jonathan, you have to talk, you have to say something because this is, just I guess Giovanni made the call about the COVID. You made the call on inflation.
Yeah, made the call. I mean,
Well, first of all, everyone look at Mirana. She's on the beach in Miami. It has to be. Look at that.
Hi,
Okay,
everyone.
sorry, go ahead, Jonathan.
no,
Sorry
I mean,
about the view. I hope it's not
You're not
hurting your
sorry.
eyes.
Yep.
Sorry, not sorry.
Here, use sunscreen.
I'm sorry,
enough.
not sorry. Yes.
Mariana, that's cold. That is just cold.
I miss you guys here. It's been
All right, sorry.
actually very nice and warm. So it's time to relax for a couple of hours and go back into the speed.
Okay. All right, turn your camera off and enjoy the beach. Jonathan, back to inflation.
Thank you.
Sorry.
yeah, I mean, I think I look at the environment. I still looking at the past regimes and everything else. To Stephen's point, just because inflation is here, it's been here, doesn't mean the market still can't go up. So I think you just need to get more selective. I still think growth outperforms. And so if you're asking me what's an actionable thing to do right now, I still think you go large cap tech, especially in the sell-off. I think that it benefits in inflationary environments and deflationary. And so I've had everybody doubling down yesterday and today. That's what we've been doing.
Jonathan, do you think that growth is going to be able to climb the wall of higher interest rates and that whole discounting argument?
I do. I do, but to be clear, large growth. So mid-cap growth, I would absolutely dump all exposure there. I did that earlier this year. I think smaller cap growth names that don't have the earnings, the positive cash flow that the large cap tech does, or the large cap growth in general does, will have a harder time coming over that burden. But something like a Microsoft or an Apple that's a cash king that's kicking off revenue, even in NVIDIA, I think we'll all do well in this environment, and I'm not overly concerned about it.
John, I would love to see a
I think earnings
scatter
are going to be
graph of
what
how you
drives
see
it.
it. Yeah, to that point too. Just you don't have maintain a scatter graph of valuations and growth rates, mid cap, large cap, do you?
I don't know, Stephen, have you ever pulled that?
I didn't do we don't do a scattergram, but through Ed Yardeni, we do follow the multiples and the earnings on these guys closely. And one of the things that's interesting is prior to this pullback, small caps were actually selling at a pretty significantly low valuation relative to their historical norm. I'm having some.
It's
computer
crazy
issues here.
because they've been getting beat up now for what, a month? One of the month, 2 months.
Well, I think what's happening, and yeah, Jonathan, you're right. But I think one of the things that's interesting, and it's to your point about the divergence inside the market. If you look at the Russell 3000, and I don't have the exact numbers, but ballpark, about 80% have had a 5 to 10% correction from their all-time high. I think about 50% have been in bear market territory in the last 12 months. So you have had a
Froze on us.
Yeah. Stevens. That might be a big, red. Stevens back. Go ahead.
Okay, sorry about that. So I think Jonathan's point about you really want to go for the companies with earnings. The challenge, I think what we're seeing in a lot of the small cap area and even in the Russell 3000 is the guys who are, still in the kind of like the .com in the business plan mode, as opposed to having real revenues, are the ones that you want to invest in. I think this earnings matter now more than they have in a long time. And not that they don't always matter, but for the last, when you have Fed easy policy like we've had and zero interest rates, you can get a lot of money raised for a lot of things that start to look like you have a business, but don't necessarily. So I think that you want to be really selective, as Jonathan said, and I would think you want to stick to the themes. But on the other end of the coin, I think a lot of value names will stay value names for an awful long time because they can't make the investments to compete. I think that's going to be a challenge.
Agree 100%. The value trap is a real thing, and I think people will see it. Again, I've been in growth for a while now, but I continue to believe that a lot of value people that think this is the big value wave will continue to be disappointed.
I think it's a quality wave for the near term with the concerns about the global economy and Russia and all that. So I think you want to focus on quality
That's a
and
great point.
stay away from speculation.
It's a good
There are times to speculate, but it's not in a financial regime change or in a highly unstable geopolitical environment. The other point I want to make, Mark,
use quality with value as interchangeable, and they're 100% not.
right. The other point I want to make is about rates moving up and what happens when they do, and why aren't our rates even higher now? You look at Germany and Japan, and even when the Fed starts to pull back from their buying or even reduces their balance sheet, if we're running at a 180 or 2% or even 1.7% 10-year, we're going to attract a lot of capital from Germany, which is, flirting with going positive. I haven't checked today, and Japan, which has been, 10 basis points for, 20 years. That yield advantage, particularly since we're the reserve currency, is a very high quality transition for them to pick up a lot of yield in a tough yield environment. So the idea that we're going to have rates run away from us, I think, is one thing that might trip people up, because I expect that we'll attract a lot more capital from the rest of the world, particularly in an unstable political environment.
Hey, Stephen, do you have any thoughts or comments around, I don't know how closely you watched the Treasury auctions yesterday, but to your point on foreign involvement, the fact that foreigners was such a big piece of the Treasury auctions yesterday?
The yield differentials are so great. And the other thing, say if you're in Europe and you look at the leadership transitions that are going on there, standing up to Russia is a challenge right now, and getting consensus is a challenge. Germany is, Schultz is not, fully supportive of arming the Ukraine. So I think that's going to be that problem of leadership is going to be an issue. And I think that's going to attract a lot of capital back to the US. Not that I think we all know the numbers on the US political system right now of near record lows, but on a relative basis, our economy and our strength is going to attract a lot of capital here. And you look at Johnson's on the hot seat, Macron's in an election period, and Schultz is new in the position, and losing Angela Merkel at a time like this is actually, I think, one of the worst things that can happen for the global economy and for for the world leadership, because I think it leaves a major void. And she was the one who could stand up to Putin because of her background, her knowledge, and also she speaks fluent Russian. So I think she's going to be greatly missed.
Yeah. And,
Mark, we have a birthday on the call today too. Angela just joined. Yep. Angela, happy birthday.
Happy. Wow.
I did. Good morning.
30.
Thank you.
33 looks great.
Happy birthday.
She's preparing for her big event.
Happy birthday.
I saw you pop on, Angela, and I was thinking, what if we all did one of these Zooms on a Peloton or on our bicycles, right?
Oh, we can make that happen. We could. We're definitely going to make something like that happen. I think the in-person biking is going to be way more fun. We'll do that in the summertime. We'll do a 361 cycling event.
Angela, this is Ann Mooney. We're going to do that in Cincinnati, and I'll hook you up with a world-class bike befitting of a world-class athlete, and I will show you the best cycling in the greater Cincinnati area.
That sounds like a plan.
And I will suck your wheel. I will be right shamelessly drafting.
It's all good. All good. I really appreciate the birthday comments. Thank you.
We're not at all competitive here, are we?
You can buy Peloton pretty cheap for sure.
Actually, look at Bill Doikler. Like he just kept moving up to on the top courts in that pickleball tournament. He never played, and it was really great meeting your wife.
Well, thank you. We were stuck in the mid-level purgatory there for quite some time.
I was volatile.
You're generous.
I went from purgatory to hell, and I was on the cusp of heaven, but they called it.
It's the way it always happens.
I have no pull. I couldn't even get a bonus round. Sorry, we digress. Any other questions on? Go ahead, Ben.
Oh, one cycle. I think we need to put a leave in the swag bags next time. But at any rate, Stephen, I just wanted to make one point, kind of going back to your interest rates. Rates here peaked back on the 18th, and we're down, since then. So I'm not. So I think that to me it's fascinating that on the rate side there hasn't been any follow through relative to the inflation expectations, which is probably a good thing, going forward. But also I just quickly if you want to have sort of a depressing read but interesting, I put a book by Tom Koenig, I guess is how you pronounce his name, former president of the Kansas City Fed, in there. And then there's a Cliff Notes version in Politico, talks about his experience back in the 70s as a bank examiner and then president of the Fed. And he's laying all this at the feet of the Fed right now, which I don't know, he might be literally talking his book a little bit, but it is a very interesting perspective. And the reference is in the chat for you all.
It's interesting, Bill. In hindsight, the Fed kept the foot on the pedal too long. I'm not sure they could have. They anticipated the fiscal policy to be as strong as it has been, and they have to plan as they can't know that that's going to get through. So I think they kept the foot on the pedal too long, and I think things rebounded faster than they anticipated too. So with their communication plan and program where they wanted to not surprise the markets, I think that actually kind of kept them in a box a little longer than they should have been. So there's clearly too much money in the system. And as that starts to slow up, that's going to change pretty quick, because if the Fed's going to go from 120 million to zero in terms of new QE, and then they're going to start rolling off part of the balance sheet, which I don't know how effective they're going to be, how quickly they're going to be able to do that. I think that's the next big challenge for the markets, is how does the Fed reduce the balance sheet? How do central banks around the world reduce their balance sheets and not create slowdowns? At a time we can't afford the slowdowns because of the massive debt buildup that we have. So it's a real dilemma for the central banks, which I think is going to put some strain on put strain on the weaker economies, where they're going to be takers of that problem. So as that's one of the concerns I think the Fed has about how fast they raise rates, because we have so much dollar debts out there that's going to create a problem for the emerging economies that are already having problems. So because they have so much dollar debt already, and if their interest costs go up, they won't be able to service the debt, and then you start to have the real breakdown in the system. So I think the Fed's going to have to err a little bit on the side of being conservative too.
This is a little Goldilocks, but if we see the inflation pressures waning a little bit, like everybody does, expect, and you see growth sort of continue, that might open a window for the Fed to go ahead and start reducing the balance sheet, under the cover, if growth continues, which would begin to bring down, all the awful multiples and things like that, as in, balance sheet to GDP and all that kind of stuff. I don't know. I mean, you talk about walking through the eye of the camel. You're trying to put the camel through the eye of the needle. There we go.
Yeah, I think the challenge is going to be, how much of the world ends up like Japan and can't get out of it versus who can grow out of it, and how do we thread the needle is right. And that's going to require a much better global coordination than we have today. The way the world is operating, even from the central banks, they were working in unison since the financial crisis, and then they've started to diverge. And it's those divergences that are going to make it a challenge to how we bring this across the finish line. But reducing the balance sheet is a big deal and has to be addressed, and that's probably Powell's biggest challenge.
Let me add into the mix the tapering. How's that gonna fare out?
The tapering's not the issue, Luke, because they've already started. It's really a non-event, because we don't need the money in the system right now. We're flush with liquidity around the world. So throwing more money at creating more debt to deal with the problem isn't really the issue. I think it's what happens when they try and reduce the balance sheet that's going to first create a concern that may be short-lived, but they've already said they're not going to do that until they raise rates. We'll see today when they start talking about, or when they start talking about raising rates, and how fast. And I think that's the other wild card for investors is, do they do a slow and steady 25 basis point series of increases, or they try and do a shock and awe to just really send a message that they're serious about it? And if they do a strong message, maybe that's all they need to do. If inflation is starting to roll over in the second half, as people think, it's a wild card, and nobody really has a clear view of it. I do think the market's view that 4 rate hikes are going to be required. Maybe you might want to take the under on that one. I think it might be less.
When's the last time the Fed did a rate hike, an initial rate hike that was like 75 bips even? Do you know?
I don't know 75. The last 50 was in 2000.
2000. So
Yeah, I remember the 50.
And a different economic scenario that they were dealing with then than we have today. The other issue that everyone has to keep in mind is the Fed is very focused on full employment, and we're getting close to hitting that number, which was one of the things that they were holding back before they would start to pull back on their policy. So I think we've met 2 of the 3 big hurdles that they have. The third one is whether we would define it as at full employment or not. And I think they're holding back on that, waiting to see the return to work scenario. So I think we'll have to keep an eye on that as well. But we are moving, I think, to an end of an easy money era in a lot of places, and that will have some shifts in valuations of all asset classes, which I think is what the volatility across all the different areas, whether it's Bitcoin or bonds, equities, or housing. I think you'll see it in all those areas now. In 76.
Any other questions, comments?
I do have a question,
Oh,
but
this
as,
is- I just got an
I-
email. Sorry, hold your thought in 2 seconds. I just got a note that John Najarian, he might join our Zoom, but we're just ending. So I think I was going to ask him to come next time. So go ahead, Ann.
I had a quick question. I don't know if this is the right forum for it. So if it's not, please, Stephen or Mark, tell me no. But just relative to what was for me a lot of new information and very valuable information relative to things like blockchain and crypto and blockchain syndicate funds that the blockchain sisters have and things like that. How are you thinking about that, Stephen, in regard to your ARS's investment thesis? And in the context of the macro global economic thesis that you've put out
Uh,
today.
we don't invest in crypto for our clients.
And I want to be really, I want to be really clear. Crypto's over here, so that's
Yep.
just context. For me, blockchain, I was really inspired by this idea of 35% of the GDP is built on trust, and
Mhm.
blockchain is related to that. So I was wondering, how does that relate to
I
this?
was actually going to split them. So,
Okay, thank you.
for us, the question is valuation. Bill and I have had this discussion for a while. We tend to try and invest in things we understand, and I still am struggling to understand the long-term outlook and how it would play out for Bitcoin. On blockchain, we started writing about that in our outlooks, I think in 2017, because we saw the productivity needs, the inefficiencies of the US, and the need for companies to take processes that were so antiquated that they needed to be fixed. And we thought blockchain is one of the ideal ways to do that because of what you said. It replaces trust with validation. The challenge with it, though, is it gets, when you look at a corporation and see how they're implementing a blockchain type of productivity improvement, it really gets diffused as you go down. So it takes parts of people's jobs, not necessarily places whole jobs. So it allows a company to improve their efficiencies. In some cases, it may do a lot more that I'm aware of yet because it's still a new area. But we see it as really creating much greater efficiencies. And I think it's going to play a much bigger role in corporate processes going forward. And that's how we're going to become much more productive and deal with the demographic issues and the unemployment issues that we're going to have and the skills issues that we have over time. And I think that's going to be one of the big benefits of it. I'm not sure how much of I guess I am a skeptic on crypto because just in my understanding of it, you need the next buyers to come in to keep the values going up. And, you have to see, will that continue? And
Yeah, I agree on that, Stephen. It's funny that you mentioned the word, that you mentioned that, because the way you describe it sounds like a Ponzi scheme of sorts. You didn't use that word, right? You didn't, but somebody mentioned how VCs, very cavalierly, the guy whose name I'm not remembering, in the Naples panel, said VCs the whole VC thing is a Ponzi scheme. And I
think what he was saying was I thought he was saying that these generalist VCs can't compete with specialist VCs in their space. I didn't hear Ponzi.
No, he used that word.
He used that word.
No, he used that phrase. He used the phrase.
Well, let's talk offline. So I want to identify that person then.
Well, I think you know who it was, but okay, we can talk offline.
Yeah, no, it was the Bioman guy. I forget his name.
Alfie.
And yes,
Alfie.
Alfie. Thank you. Right.
What is it again? I'd like to, or put it in the chat because I forget.
The artist, otherwise known as Prince, now otherwise known as Alfie.
Yeah.
Oh, okay, Alfie.
Right. I think he's got a point, because there are a lot of VCs that are out there that are purely financially oriented, but I think that a lot of the people here in the 361 community are very much value added VC folks. Where they're interested in helping. And that's a whole
Erica made a clarification, because we want to be fair to everybody, that we did not use that word. We thought that they take advantage, you'd say, Erica?
So
I couldn't quite hear that.
I'm sorry. In general, VCs can oftentimes, get a bad rap, and you do have to be careful around it sometimes, for sure. I mean, you have to know who your investors are as they're coming in, and there's some bad apples in the bunch. But I think what he was saying is that, yes, that can happen. And I agree with you, Mark, that he was saying that generalists aren't going to be successful. So if they're taking a retainer and working with him, they don't know what the hell they're talking about. They're not going to be successful helping him, right? Or anyone in the space. So I don't think he used the word Ponzi scheme. And I do think that VCs can take advantage, but I do agree with whoever made the other statement that there's also some great VCs that really help companies and really do value add. And, little companies have no staff and no money generally to get started with. And so if you can find a group of really smart, intelligent people to mentor you and help you and give you their connections, then it can really matter. So it's sort of like a general contractor, right? General contractors have really bad reputations and we all like to bitch about them. But the reality is we all call them up when we need our kitchen remodeled. And a lot of times it works out great. So, you just can't generalize, I don't think, like that with everyone. So that's just my 2 cents.
If I also can add to that, I've been 4 years in startup world and spoke with numerous VCs and family offices and accelerator programs and government-backed programs, etc. So the main mistake that entrepreneurs make is not to really do good due diligence on VCs. So it takes time, it takes effort, but also right questions to ask. So first thing is, when you ask, when you go into any conversation with the VC, first question is, okay, which fund this is, or which round of your fund this is, which stage within this are the first or second or third funding round you are at. So for example, if their fund is for 6 years, and if I start speaking with them when they are third year in, then for me as an entrepreneur, that could be a red flag, because for my business, I will need more time. So probably 4 or 5 years instead of 2 that are left for them. And that means that they will try to squeeze entrepreneurs and business as much as possible. So for some businesses that can work, for some not. So I guess that Alfie was coming from that perspective, and therefore it can be mistaken, what VCs can do. They can do a lot for early stage startups. But again, if you're in the right space, there are lots of what Alfie said, Ponzi schemes. Yes, they are. But again, it's down to entrepreneur to do great due diligence. So I wasn't relying much on VCs, because for me, I understood it's too early. So bootstrapping was an option, and angel investors. So it's all about both sides to do great due diligence and find that perfect fit. So whoever that is. Thank you.
I just wanted to make a quick comment on Bitcoin as well. There's ways to invest in the space without it being so volatile. Right now I have a little opportunity zone situation that's into data centers supporting the Bitcoin. So you get the Bitcoin, you get, the opportunity zone tax advantages, and it's quite safe, and it's a long-term hold. So there are ways to invest around Bitcoin and get in the space.
The picks and shovels of sorts.
Yes, exactly. Exactly. So thank you.
I also like the fund-to-fund structure is a way to wade into the waters. Glad Capucin has a comment.
I agree with that. Let people that really know what they're talking about do deep dives and diligence into all that deal flow.
Hey, Jill, who was that saying, reinforcing the fund of funds? I'm trying to look on my screen here and I'm not seeing who's speaking.
What's me? I said that, Mark. I like the fund of funds in this space. It's me. I have my mask on, so I got went off camera. So we're definitely scratching the itch here. We want to pursue it in a smart way, and some people are really excited, and some people are skeptical. So that's good. To Brittany's point earlier, and there she is.
One item I haven't heard really discussed in the crypto is the utilization rate, or at least each individual crypto is within the market. There's not real good information that I can find that really tells what or how each of those crypto assets are being utilized, because that's really the driver in increasing the value of those.
Good question, Luke. That's like a half-day session, for sure, because you have, I would say, like at a really high level, you can break it down between coins that either are or potentially being used transactionally, such as buying, your Starbucks in the morning, versus coins that are necessary for building out further infrastructure very, very broadly in the blockchain space. Ether, Ethereum essentially is that type of thing. You need ETH in order to, if you want to build something on an Ethereum blockchain, you have to have ETH to pay the gas fees. It's very similar across others. So in terms of how coins are being used, it's just exploding, and it's very different use cases across the board. But I think kind of the long and short of it is that the space continues to expand, and I think that going back to Ann's original question, you've got blockchain in one silo, if you will, which is tremendous. The potential there is absolutely amazing for transforming business applications. And then you have, all the projects and the coins that are being put out there that are attempting to do new things, such as in decentralized finance and all that. Then you've got the currencies, which are Bitcoins and Bitcoin-like coins that all have fixed monetary policy. And then, I'll draw sort of like one more box and put it around kind of like NFTs and metaverse. And so you've got a lot of participation in any one of those verticals. So it just depends on how you want to look at it. But it's growing. It's growing exponentially all over the place.
I think on blockchain build, companies don't have a choice now. They have to start figuring out how they're going to improve their efficiencies and improve their productivity to compete. And they need to redirect that money to more technologies so they can lower their costs and be more productive. So I think that's going to be the key element and blockchain is going to be one of the key elements of getting us there.
So what would be the indicator then that the adoption of that is really kind of taking root? I mean, you're going to see blockchains or different companies make partnerships with different coin assets or asset classes within the crypto space to really kind of drive the attention that, hey, we're utilizing this within our, infrastructure or technology platforms in some form or fashion to really kind of drive that. Because I'm looking at from just regular product adoption for just, let's just say a new way of doing business. I mean, every company, kind of breaks it down into a value chain, how they can take advantage of it and then do their steps and process and procedures of how they adopt it and then capitalize on it. So you have to look at it the same kind of how you break it down, but just seems like there's a lot of interest and everyone wants to go into all the different coins and they put all this money in, but yet really I look at it as, okay, who's really using it right now? How is it being utilized? And what are the factors to really kind of make it grow? Because that's the only thing that's really going to sustain it in a growth sense.
I own and run some e-commerce stores, and I actually saw a first Bitcoin transaction come through a couple months ago. So that was interesting to see where like a random person purchased the product through using their crypto coin, and the sale went through, and the way it went, it was an API or there's a plugin through Shopify which allows that to happen. I'm not exactly sure because it wasn't my store, but how it converts back to cash or if you have to hold it or whatnot. But yeah, it was just interesting to see the first, and it was a younger kid that had it. So, but
Nick,
from what
Nick, was it a big dollar transaction?
no, it was just to buy like cosmetics. Looks like it was a guy buying it for his girlfriend for say $40 or so. So nothing big. There was an issue with it while it happened because he was worried. So the transaction, he clicks save or like send, and then it didn't seem to go through. So he was contacting the support because he's very worried, because that is the problem with the Bitcoins. When you send it, it's hard to get that. You can't contact your credit card. It's hard to complain about it. But yeah, so it's interesting because just from what I understand is there's a very small amount of people that own most of those coins, the early adopters. So how does it like how many things do those people need to buy with the coins? You know what I mean? So if they're it's willing enough for the whole market to purchase, and then you have that whole problem of for the money to transfer quickly, you have to give a tip because the person, the miners and whatnot, needs to be paid. So the higher the tip you give, the faster it happens. Otherwise, it could take like literally a week for it to happen. So then you get back to the point where you're still just paying a fee, like you might as well use your credit card or something else. So who knows?
So, Overstock.com has accepted Bitcoin since like 2010. So there's been a ton of financial transactions on Overstock.com for big pieces of furniture, multiple pieces of items, and many companies around the world have been accepting Bitcoin for a long time, actually. So just to let you know, I know of the CEO out of Europe. He's been working with the Central Bank of Europe to put a privacy protocol with the Central Bank of Europe to get them on the blockchain, but also keep the transactions private. His company is not raising money. They're not taking money in Panther protocol, but he has seated a founder and founded a company here in this country called Fluent.finance, which I put in the group, and they're going to integrate with the regular banks, just like Zelle. And I think it's going to happen fast, honestly. And that is when I think it's really going to adopt. I don't know how many of you use Zelle, but I mean, I use it all the time, send my kids money and money back and forth. It's super easy and convenient. And I think it's going to be a similar type integration with the federated banks like that. So if you guys want to look up to them, so that's just interesting to see how it's coming.
Yeah, you can buy coffee at Starbucks with Bitcoin. PayPal accepts Bitcoin. Also, it was mentioned, I think it was mentioned earlier on this forum, but, it was mentioned on Sunday, El Salvador has declared Bitcoin, they're an acceptable currency. And so there's all kinds of stuff going on, small purchases, everything going on in El Salvador. So it's there. I think, it's just not publicized, all that much, but adoption is happening slowly. I think in general, it's really tough because and actually Chris Hunter on Sunday, talked a little bit about using Bitcoin as a unit of account unit of account, I believe is the proper word. And that one really has some very interesting possibilities where you say you're buying like $100 million worth of oil, and that's a transaction that's settled in US dollars right now, but it can take a little while to do that. If you think of it this way, you could go from your fiat for your purchase that gets translated into, say, like a stable coin gets translated into BTC gets processed over the blockchain network, comes out on a stable coin, comes out on the receiver's domestic fiat. All that could potentially happen in minutes.
Sure. So I guess what to kind of expand on your point there, Bill. I mean, the transactions we're talking about though are just simple exchange type level transactions, right? It's one currency into another. It's basically cryptocurrency versus US dollar, right? You know, you're initially buying coin and then you're buying a product which eventually turns back into US dollars. So it's not really, it's utilizing it, but it's not really expanding it to the point where it's going to grow it, right? I mean, you know, low level transactions like that, you know, are probably too small to really do anything at any point. But I mean, it's good that the system's starting to kind of like figure out how to do those purchases, because I think that kind of feeds the bigger picture as far as how companies can take advantage of it. I mean, even Tesla is offering, you know, products that you can purchase in certain types of cryptocurrencies. So, you know, I'm more or less talking about when do you get to the point where, you know, it's either segmented off to where you can only purchase certain things that utilize a cryptocurrency, and it can't be, you know, reconverted like the NFT level type of thing, where that growth kind of stays within the crypto side, right? Because once the money stays in the crypto side, then, you know, correct me if I'm wrong, that would build that crypto base as far as the valuation underneath it. If it keeps going back and forth, you're not really going to get growth, right? Exchanging from one to next.
No, well, I mean, you have to have the coin in order to use it. So that means you have to buy a coin. So it's gonna expand. I think, you know, things being denominated in Bitcoin, we're a ways off, you know, from that. But you know, Bitcoin, I think that was said on Sunday that the total, you know, the total market cap of all coins right now is let's just say really round numbers, like $2 trillion, and Bitcoin is roughly half that. So, you know, 2010 to 2022, 12 years, you know, a currency goes from zero to almost $1 trillion, you know, market cap. You know, that's not bad. That's not bad. And it's continuing to grow. So definitely, you know, stay tuned. There's more to come.
And Bill, the big demand is
Well-
the next leg of demand. Isn't that coming from the endowments, foundations, and pension plans, not the individuals? So that's actually, that's what people are playing for now, is get them in and push the price up. Right. So
Yeah, they've been moving in slowly, stealthily for the last couple of years.
Mhm.
And so I think the bigger purchases are coming.
We should ask Kathleen Brown from Denison, the CIO of their $1 billion endowment. She was talking about this 18 months ago.
Yeah. Well, you know, back when I was at Morgan Creek, you know, my clients, it's all public. You know, my clients, Fairfax County, invested in 2018 into our venture fund, of which 15% of that was in Bitcoin at an average cost of $5,000. They're pretty happy right now, even with the drawdown.
it doesn't mean they're not going to complain about the drawdown. They're just
Yeah.
Okay, so this is definitely diverted into a Bitcoin sorts discussion and related topics.
Sorry,
Steve,
Mark, I think I started it with the blockchain question, but
That's
Not
okay.
at all.
All good.
pardon.
All good. Any other topics? I'm on the airplane. It's supposed to leave in about 5 minutes.
just a note. Anessa put a note in the messaging section that our firm's having a call on private equity investing in the public markets for small caps and micro caps. So for those who are looking for the transition of risk from private to public and how that works, my partner Ross Taylor is going to give a pretty interesting update on that and some very interesting ideas. And I think the pullback has created some very attractive valuations there. So more to come on that. And as we said, you got to be careful in that area, but there's some interesting opportunities. So I'm going to jump off.
Steven,
Yep.
Steven, is the link there in the chat? The direct link?
Anissa put it in earlier. Yep.
Okay.
Okay. Thanks, Mark. Thank you all. And great time in Florida for the
everyone.
group that is now.
Thanks,
Bye-bye.
Stephen. Great as
Bye-bye.
usual.